Camera for Canada's Mortgage Minute on April 30th, this fine Tuesday, the last day of the month. Hey, over the years, I have done a ton of loans, whether it be in the mortgage business where I've been in for the last 6+ years, or in the car business where I spent 12 years. I have met thousands of people over that time, and I've seen various different degrees of money stewardship over those years. And there's been a few common denominators that the people that are really successful have practiced, and those that are unsuccessful haven't grasped. So I thought, you know what, I'd take a few minutes and share those with you today. So if you're a young person starting out, these are a few key things that I think are really important, and again, from my vast experience of meeting people over the years, seem to play a pivotal role in their financial success. Number one, you need to know what healthy spending looks like. Now this varies from person to person, but the bottom line is for every dollar you make, you need to allocate it accordingly. And roughly about half of it should be going towards, of your take-home pay should be going towards the things that you need. And needs are things that are necessities. Let's say your hydro bill, your car payments, those sorts of things, or your telephone bill, your grocery, you got to eat, those things. 30% of it should be going to your wants. Now, maybe that's a little high, but hey, this society we live in, people have a lot of wants. And I guess really the differentiation is between need and want. Do you need maybe 3 cell phones? Do you need the 52-inch plasma TV? I don't know. It's more of a want. So you really have to figure the two out there. And about 20% of your money should be allocated to savings. Unfortunately, these days, it's more like 0 for a lot of people. But the folks that have been successful, man, they've managed to sock some away. Now, the other key that successful people do is they start saving immediately. The younger they are, the people I've met that have been really young that started saving early, while they're miles ahead. And really, it's because of the power of compounding kicks in. As an example, let's say you started saving $5,000 a year at age 25. Now, it may seem like a lot for some, but really when you break it down, it's just a little over $400 a month. So let's say you start doing that until you're 70 and earning about 6% compounded return. Well, it's going to be easy that by that time, you'll easily be a millionaire by the time it's all over. However, if you wait till you're about 45 years old to start socking money away, you need basically $18,000 a year to save by the time you hit 70 to equal the same amount of money. So you got to put a lot more away. So the earlier you start, the less you need, because compounding works in your favor and time's on your side. And don't forget, there's a nasty thing called inflation, which is going to eat away at this million you want. So chances are you're going to probably need even more than that. Now, the other thing I find in this time and age we're living in, and for those, and it's on TV, it's prevalent everywhere in our culture, movies, television, you name it. Now, might be kind of strange to some of you, but I haven't had cable for 20 years, so I've kind of avoided a lot of this, as I call it, crap. It's a lifestyle that they portray on TV, and it seems like everybody's living large. Everybody's got all the toys, they've got all this, that, and everything else. And you would think that watching television, if you're a young person, man, this is what I expect. And you know what? I see a lot of that. There's a lot of young people starting out who figure that they should be living like their mom and dad or their grandparents right away. I mean, really, what's the delay? I should have the 2 cars, I should have the big house, I should have the cottage, I should have all these things. Now, I'm not lecturing you to say don't. I mean, hey, maybe those things are over time worth having and those are things you want. But clearly, you're not going to have them day one. And if you do want them really, really quick, the only way to get them is to go into debt for them. And you know what? That's not going to make a heck of a lot of sense either. So you've got to look at it and bide your time and say, look, you know what? You've got to pay the price along the way. Everybody else before you paid the price, they took them time before they got the things they wanted. And you're going to have to do the same. And so if you temper your expectations accordingly, you will get really far ahead. I give you an interesting story. I had a client just the other day, a young lady, earning about $40,000 a year and already had $80,000 socked away at the age of 30. That's amazing. Now, contrast to that to a couple that I had about 3 months ago I met that were earning $128,000 a year, and guess what? Their net worth was negative $50,000. They owed 50 grand in debt, had nothing to show for it. And again, it's because their balance wasn't there between what their needs and wants were and the savings. And the bottom line is you got to start at some point. It doesn't matter how good your job is or how great you think the pension plan is or who's going to take care of you. You got to look after you and make sure that you're covered off. Anyway, I thought I'd share those few points. Hopefully they resonate with some of you, and if you need some help, we've even got a little budgeting software we give out to our clients to help you kind of do those sorts of things. There's lots of resources out there on all this sorts of stuff and material that you can read that'll really get you down on the right path. Anyways, if you need anything mortgage-wise, hey, you know where to find us. It's Cam Broad with the Auxilium team. I wish you the best for the day, and I will see you in May.